As you prepare for retirement and start calculating all your expenses, you're going to want to run the numbers twice on taxes. Why? Because after healthcare, taxes will be your second largest expense in retirement. If you don't plan for your lifetime tax bill, you could unintentionally sink your retirement or risk not leaving wealth to the next generation. Failing to account for taxes is a mistake DIYers make all the time. So if there's an opportunity to pay less taxes, I say take it. Today I'm going to walk you through a case study showing how you can generate up to $100,000 of income in retirement while paying nothing in federal income taxes. Before you assume this is something that could get the attention of Uncle Sam, it's not. This is simply smart planning. It's knowing the rules and using them correctly. When you understand how different accounts are taxed, you can strategically pull income from the right places to stay under certain thresholds and potentially eliminate your tax bill entirely. Let's crunch some numbers. But first, I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management. Let me introduce you to our couple. I'd like you to meet Joe and Sally. And of course, their names have been changed to protect identity, but they're 67 years old. They are retired. And as far as income goes, they've got Social Security coming in. He gets about $3,200 a month. She gets about $2,000 a month, which is $24 a year. So in total, they've got $62,400 of Social Security income. And as far as their balance sheet goes, they've got a taxable brokerage account at about $500,000. They've got a combined roughly $650,000 in IRAs. They each have some small Roth IRAs, and they own their home, and it's paid for free and clear. So at this point in time, I'm going to take you over to their tax projection, and I'm going to show you how they're able to take $100,000 of income, how to live on that, and pay nothing in taxes. And we're going to key in here on the first projection here, which is just their Social Security income only. And if all they were living on was their Social Security income, the way the provisional income system works on Social Security is that they wouldn't have to pay anything in taxes if Social Security was all they had. But we just told you they want to live on more than $62,400. And so now the question is, where does that come from? Well, for Joe and Sally, they had another $10,000 coming from dividends. And you can see right away that the extra income there, dividends, these were ordinary dividends. They were taxed as ordinary dividends. And so anyways, it pulled in an additional $4,600 of Social Security income because the total income had gone up. Once again, we're at $72,400 of income, and they wanted to live on $100,000. So what I see a lot of people doing this on their own do, and quite frankly, some bad financial advisors do, is they'll take the difference, the $27,600, they'll take that out straight from the traditional IRA. And I want to focus your attention on this column right here, which shows the additional $27,600 coming from the IRA. And so it does a couple of things. The first obvious thing is it gets them to that $100,000 mark. But the second more subtle thing is it now impacts provisional income on Social Security, and so much more of the Social Security income becomes taxable because every dollar coming out of your IRA is taxed at ordinary income. And so at this point in time, the additional monies being taxed on that Social Security income is now going to result in them having a federal tax bill. Over $1,700 in taxes they're going to pay because they pulled the additional lifestyle money out of that IRA. And this is where smart planning comes into play. And so let's take a look at inside of that brokerage account. About half that brokerage account was gains, and the other half was their contribution over years and years of saving. And so what we ended up doing for Joe and Sally is we took $16,000. We basically sold investments inside of the taxable brokerage account, $16,000 worth, and half of that was gains. So you can see the long-term capital gains coming in right here. And what that allowed us to do was take less money in the IRA distribution. And so instead of that IRA distribution being $27,600, we're able to reduce that down to $11,600. And this had a huge impact. This shows the taxable Social Security was so much less because capital gains for them were taxed at 0. And so there's a lot less Social Security being taxed. And at the end of the day, they ended up paying nothing in taxes. Take a look right here. That is a beautiful number right there. I'm going to pull up their tax report here. Take a look. So even though they had $62,400 of Social Security income, the part that hit their AGI was only $37,000. And then on top of that, it resulted in a total income of only $39,085 because they knew the rules and they're using the rules to their advantage. So take a look at where long-term capital gains were at. Because that we were able to keep their income below $96,700 for a couple that's married filing jointly, that meant that those long-term capital gains were taxed at 0, which had huge impact on keeping the tax bill lower. The other thing is, on their ordinary income, we're able to keep them in that 10% bracket. And then we'll show you right here, they were taking the standard deduction, $31,500. So that ended up driving their taxable income down to $7,585, essentially resulting in a $0 tax bill. Huge, huge savings. And it just simply comes from knowing the rules, knowing how the coordination goes of ordinary income, knowing what income sources are ordinary income, knowing the impact on your Social Security income, and then knowing the capital gains buckets. There's 3 capital gains buckets, 0, 15, and 20. And so by coordinating the tax brackets, you ultimately can save a whole bunch of money in taxes just by knowing the rules. And so this is an example that worked out really well for Joe and Sally. And I know with some careful planning, you can do it too. I hope you enjoyed learning how to create $100,000 of income while paying nothing in taxes. But in real life, paying nothing in taxes may not be your goal every single year. In fact, there are times where it does make sense to pay a little bit in taxes today in order to save a lot of money in taxes over your lifetime. And doing a lifetime tax projection is something that's really, really important. So if you want to learn more about this, or you want to learn about how Roth conversions work, and if you think that in the future taxes are going to be higher than they are today, that's what I personally think, then doing some small Roth conversions right now can make a lot of sense. Check out this video here to learn more about how to do it and why it could be so effective. And if anything on this video was interesting to you or resonated with you, or if you want some help or some guidance, you can learn more about our firm by visiting seasidewealth.com. And we look forward to seeing you on the next one.